think it's reasonable to think there will be what I might call sort of structural change in the economy coming out of the COVID experience, and there will be some parts of the economy which will just, I'm afraid, not be viable going forwards in the acceptable time frame that they plan for.
Which bits of the economy?
Well, I think what I say, if you look at this uneven pattern of recovery, and you think, what are the sort of characteristics of those parts that haven't recovered effectively? It is that they're often sectors that have a very high, what I might call sort of social consumption element to them, which involves people working or indeed consuming them at very close quarters.
So hospitality, restaurants, bars, things like that.
And, I mean, the UK economy does have a higher share of those sectors than quite a number of, when you look at other developed countries, interestingly. It's not massively high, but it is actually, we are at the top of that list.
So we're potentially more exposed to the economic shock from that perspective?
I think that helps to explain when people compare forecasts across countries and say, one of the reasons they say, why does the UK look somewhat more exposed? That helps. That's one of the factors that helps to explain it, yes.
One of the interesting things that's certainly evolving is the bank's attitude towards interest rates and specifically negative interest rates. Now, hitherto, there's been a slight kind of reluctance to go there, but that's perhaps changing now, isn't it?
Well, the message that we're giving today is, if we think about the toolbox of things that we can pull out and use in particular circumstances, two things. First, obviously, the COVID shock has forced us and required us to look very carefully at how many things can we put in the toolbox, because we start in a position where, with interest rates so near to zero, the toolbox looks, thinner in terms of its contents than in a normal world. We've had to innovate. We've had to, look very carefully at the toolbox over recent months. Our conclusion, having spent time looking at negative rates, is they should be in the toolbox. There's no reason not to have them in the toolbox. It's a matter of principle. But we're not looking to implement them at the moment. We're not about to take a decision to do it. We're not at that point.
Okay, that's interesting. And another thing that's kind of slightly changed is now you have the possibility of a no-deal Brexit within your forecast. You hadn't done that before, had you?
It is very complicated at the moment for the reason that, of course, both COVID and Brexit could potentially negatively affect trade, if you're thinking about this world. COVID is the biggest shock in all our work suggests COVID is the biggest shock. Moreover, of course, COVID has already had an effect on trade. Quite clearly, you can see it in the data. So, of course, you then get to the extremely complicated question, which I don't think we're in a position to give very much, frankly, useful guidance on at the moment, which is to say, how much of the, if you think about, the less good outcomes in Brexit than the central case, but how much of that effect on trade has actually already been taken over by what's happened with COVID?
So what? So COVID somewhat dwarfs the impact of a no-deal?
I think at the moment it does dwarf it.
It dwarfs the impact of a no-deal Brexit?
Yeah, I think it does, at the moment, yes.